Welcome to China Events, I am Jason. In order to deal with the worsening fiscal deficit situation, the U.S. Treasury Department for the first time in 2.5 years to increase the scale of long-term bond tender, so that Fitch early one day downgraded the U.S. government credit rating. On Wednesday, the U.S. Treasury announced that it will sell $103 billion of long-term bonds next week, more than the previous $96 billion, slightly higher than the level expected by most traders. At the same time, the U.S. government borrowing needs to grow alarmingly. The expected size of the quarter's net borrowing from July to September was revised upward to $1 trillion, which means that the Treasury needs to issue $1 trillion of debt in the third quarter. Due to the worsening U.S. deficit situation, Fitch Ratings on Tuesday downgraded the U.S. sovereign credit rating by one level to AA+. Fitch said the U.S. government debt burden remains high and increasing, and is expected to continue to deteriorate the financial situation in the next 3 years. The upcoming U.S. debt tsunami test market demand for U.S. debt, 10-year U.S. bond yield soared to the highest level since November 2022. It is worth mentioning that, due to the strong liquidity, 10-year U.S. bond yields are known as the anchor of global asset pricing, and its surge tends to cause violent turbulence in the financial markets, and further increase the possibility of recession. In fact, 2 months ago, Fitch has already put the United States into the negative watch list. The fact that the U.S. still hasn't been removed from this list after the passage of its latest debt bill is itself a sign that the U.S. rating is likely to be downgraded. A credit downgrade is also a foregone conclusion for the U.S. in light of its growing political brinkmanship and the risk of debt default. Fitch points out that within the past few decades, the U.S. finances and debt have been deteriorating, especially with debt ceiling after debt ceiling, adding to the risk of U.S. debt defaults, which in turn affects U.S. credit. More interestingly, in response to the downgrade of the U.S. credit rating, Yellen's latest response on August 2 EST said, "I strongly disagree with Fitch's decision, which is completely unfounded." Fitch's flawed assessment was based on outdated data. Yellen added, "At the end of the day, Fitch's decision does not change what we all already know, that U.S. Treasuries remain the world's most important safe and liquid asset." This was followed by a similar reaction from a White House spokesman. But in fact, a similar reaction from top U.S. officials is of little significance, and will neither influence the rating agency's decisions nor change some of the U.S.'s rogue practices. Today, the United States is not only facing a huge amount of debt, the risk of U.S. debt is also growing. In particular, before the debt ceiling agreement was reached in June, the U.S. owed $31.4 trillion in debt, and by July, the debt had reached $32.67 trillion. Moreover, aggressive interest rate hikes by the Federal Reserve have led to a high interest rate environment, which has increased the burden of interest on the U.S. debt. Congress budgets that interest costs will double to 3.6% of GDP by the end of the decade. However, Medicare and Social Security increased to 1.5% of GDP over the same period, and multiple Social Security funds will be depleted, which will place an even greater burden on the Treasury. In addition, 2 years from now, the U.S. tax cuts, while expiring, may be made permanent under political pressure, which will also exacerbate the U.S. fiscal deficit. So the situation in the United States will only get worse in the long run. Of course, the U.S. dollar, as the world's most important reserve currency, has brought some support to the U.S. rating. But even a stronger economy and currency status can't be subjected to U.S. manipulation. Today, it seems that the first thing to be affected by a downgrade of the U.S. sovereign rating is U.S. Treasuries. Normally, a sovereign credit downgrade could trigger investor concerns about U.S. bonds, causing bond prices to fall. That's happening now, with the median yield on recently issued U.S. Treasuries already significantly higher than it was in June. And for many passively managed funds, the change in ratings is forcing these funds to passively adjust their positions in U.S. bonds. This will cause market turmoil that could lead to a bond sell-off and volatility in the money markets. This market turmoil could have a negative impact on the economy. What was subsequently impacted was the dollar. The dollar had a hard time just making the downtrend and bouncing back to 102 for a short period of time. But now it seems that without the support of more interest rate hikes and suffering a credit rating downgrade, the dollar is feared to quickly fall back below 100 and continue to fall significantly. Analysis pointed out that the Federal Reserve for more than a year to continue to raise interest rates, as interest rates rise to raise financing needs, in the absence of excessive money printing and other measures to trigger a political catastrophe under the premise of the U.S. government's ability to change the fiscal path has become more and more limited. Without radical measures, the government will almost certainly be unable to make ends meet, and rising risk-free interest rates will exclude private investment and erode the value of stocks. Worse, the U.S. government's loss of fiscal maneuvering room could lead to a situation where, in the face of the next crisis, whether financial, health, or military, it is not simply a matter of being able to pay its way out of the hole, but may have to pay the price domestically in tax increases, inflation, and cuts to national benefits. And in the latest development of de-dollarization, the BRICS countries will hold a summit in Johannesburg, South Africa, from August 22 to 24, and multiple sources indicate that a new currency pegged to gold may be announced. And the new currency has been endorsed by more than 40 countries. And thus another breakthrough in de-dollarization. Especially in the context of the downgrade of the U.S. credit, the new currency with gold as an anchor is becoming more and more popular. At the same time, more and more countries are also using gold to replace the US dollar and US Treasury bonds. For example, the World Gold Council on August 2 released the latest data show that the first half of this year, global central bank net gold purchases totaled 387 tons. This is the highest total for the first half of the year since the association began compiling relevant data in 2000. Following the 2022 global central bank holdings of gold hit the highest level since records began, global central banks continue to favor gold reserves. The survey showed that at least 70% of central banks plan to continue increasing their gold reserves next to hedge their exposure to the US dollar and US Treasuries. As of August 3, at least 122 countries have begun to de-dollarize by a variety of methods, including increasing physical gold reserves, significantly liquidating US Treasuries, switching to non-dollar currencies such as the Chinese yuan for oil transactions, and signing a wide range of local currency settlements, as well as swap agreements. The flames of global de-dollarization are set to spread further, especially with the downgrading of the United States credit rating and the declaration of monetary independence by at least 11 states in the United States.